Hello guys and girls, welcome back to my YouTube channel. This is your host, Josh Mount, and today I'll be bringing you an introductory video to Forex. And this video is going to be very helpful to any beginner who doesn't understand the basic terminologies used in the Forex market. These terminologies aren't necessarily just thrown around in the Forex market. You can find some of them when you're using the futures market. That's you're trading commodities like gold and silver and copper and whatever. You can also find some of these basic terminologies in there. But before we get into the video, guys, please, the like button. The like button. Please do smash the like button, because if you do, you'll be helping the channel. You help this channel grow. By smashing the like button, YouTube will be encouraged to share our content with other people. So you share it with other traders and people like that, and it helps the channel grow so that I can be able to make more content for you guys. Also, if you are new to this channel, please do subscribe, or if you have already watched my videos and haven't already, please do subscribe, please. And I will be releasing 2 or 3 videos per week that show you certain strategies in the Forex market, which goes in depth. So it goes beyond these introductory terms and stuff like that, and it goes right into strategies that are profitable and that will make you a profitable trader in the end. Okay, so let's get right into the video. So what is Forex? That's a very interesting question. Forex is a term coined from 2 words almost everyone will be familiar with. That's foreign and exchange, right? So if you don't know what foreign exchange is, it's like you have an amount of money in a certain currency, and then you buy a different currency with that amount of money. So say you have $100, right? And the exchange rate between the USA and maybe Canada is $1 is equal to 1.5 Canadian dollars, right? So if you have $100, at that exchange rate, it's worth 150 Canadian dollars, right? So you buy Canadian dollars, and in that same case, you are losing dollars, right? You are not keeping the US dollars. So you are, in that case, you are selling your US dollars, if you get me. So maybe you're going on a vacation to Montreal or something like that. You have to do a bit of foreign exchange so that you can have that money before you get there. The Forex market is where banks and mostly countries, so you have like governmental agencies and stuff, they move money between them. So maybe there's a bank in Switzerland and there's a bank in the USA. You know, that's the platform they work on, the Forex market. It's a very big platform. I'm sure many people are very familiar with this stat. As of now, in 2020, the amount of money that is traded daily on the Forex market, like the entire Forex market, is $6.3 trillion, right? Which is a lot of money. It's like, who knows? I mean, it's like so much money. And for each beginning trader or anyone who is even still in the Forex market, it's like, how do I get a piece of this? How do I get a piece of 6.3 trillion, right? But you have to take it into consideration, because it's like so much money, and you can have your part, or you can also lose your part and contribute to them. So it's always important that you learn and know what you're doing before you actually get into the market, or before you get in and start pressing the buy or sell button. So how can you participate in the Forex market? Well, as I'm sitting here, I think that maybe 99% of my audience is not a major bank head. You are not a leader in a major bank. So how do you trade in the Forex market then? Well, you can use a broker. And a broker is usually a middleman or middleman company, right? So it's like an intermediary between the retailers, that's you, the customer, right? And the major banks. So they get to trade on the platform the major banks are trading on, but they trade on your behalf. So let's say you want to buy a certain pair, you execute your order gets filled and it goes to your broker, and your broker executes it in the actual forex market on your behalf. Okay, so if you make money on it, your broker just gives you the profit, and if you lose money, he takes, you're going to take what you lost from your account. So there are two types of brokers, and I think there's only one type of broker everyone wants to work with. But the first type of broker is the one that everyone should want to work with, at least normally, which is the regulated broker. So you have, these are brokers that are like supervised, or they are audited or checked. I mean, they have like people above them who are usually national agencies, maybe responsible for financial aspects or something like that. You have the CFTC in the US and you have the NFA, right? So the one you do not want to work with are the unregulated brokers with no regulation. There's nobody or there's no higher power that's checking their businesses. So these brokers can usually be scams. Like, they're actually not trading. Usually, some of them are actually not trading on the actual forex market, and some of them you make a deposit, you can't get your money back. You could take a trade and maybe your price gets to your take profit or stop loss, and they don't fill it, and intentionally don't fill it. They are like trying to scam people. So you want to avoid that. At least if you want to keep your money, you definitely want to avoid unregulated brokers. So before you work with any broker, you have to check if they are regulated or not. And some examples of regulated brokers for people in the US, Forex.com and Wanda. And in other parts of the world, you can use IG if it's available in your country, IG markets, and people like that. Brokers are, so you want to always check if they are regulated or not. In Forex, you are doing one of three things. It's either you are not trading, that means maybe you are sitting and waiting for a trading opportunity or whatever, or it's either you are buying or you are also selling. So you could, these are like the three positions, but in actual sense, there are only two active positions you can take. So when you buy, we say you are going long, and when you sell, you say you are going short. And you can hear the words like, these people are bulls, these people are bears. Bulls is just someone who is expecting the price to go up, and a bear is someone who is expecting the price to go down. So you can hear a bullish market, the market is on the rise. In a bearish market, you expect what the market is going down. So that's like some of the basic terms. And what's a currency pair? Yeah. So we are on currency pairs, and for Forex, as I said previously, you are looking at foreign exchange, but the exchange of currencies, right? So it's one currency against another. So let's say, and in my previous example, right, let's say you had the US dollar, right? And then you switched it for a Canadian dollar. So in this case, you are buying Canadian dollars and you are selling US dollars. You get it? So that's what you'll be doing on the Forex market. That's how you see it. So if you think that the Canadian dollar, right, just the Canadian dollar, as opposed to the US dollar, you expect that the Canadian dollar will be stronger in the future, maybe a near future, right? You expect the Canadian dollar will be stronger in the future and the US dollar will rather reduce in value, right? Then in that case, if you had a Forex pair, which is the US dollar against the Canadian dollar, you'd be selling the Canadian dollar, right? No, you'll be selling the US dollar and you'll be buying the Canadian dollar, as we did in our previous example. So a currency pair, as I previously said, it's one currency against another. So usually you see symbols for the currency pairs, and usually the first two, usually every currency is represented by three letters, right? So you have the country that the currency is from. So if the currency is from the US, the first two letters of the currency will have to be acronyms that can be traced back to the United States, if you get what I'm saying. So we have the USD, as you can see here. So the USD, the first two letters, United States, US. And then the D, right? The D coming in is the name of the currency. Okay. So in this case, you have the United States dollar, that's the USD. And another country, you can have the Aussie dollar, right? That's for the Australian dollar. So that's AUD. You have the Japanese yen, that's JPY, right? And so on and so forth. You have NZD, that's the New Zealand dollar. You have the CHF, that's the Swiss franc, and so on and so forth. But one thing you have to always have in mind is that which one is your base pair and which one is your quote currency, right? So you have a base currency and a quote currency. And when you see the name of the pair, the first currency is your base currency, and the second one is your quote currency. Okay, and just before we go, right, you see EUR/USD, that's the euro dollar, right? The euro doesn't like follow the normal convention when you have the first two letters, right, being the name of a country, because the euro is like not the euro is like an international currency, so it's not like for one country. So if you are in the Netherlands, right, you are using the same euros as someone who is in Germany is also using. So the euro is represented by euro, but besides the euro, there you just don't have like such big pairs. So usually it's just the first two letters being the name of the country and the last letter being the name of the currency. Okay. And so how do you trade in the Forex market? That's a good question. Well, in the Forex market, let's say I expect Euro USD to go up, right? So I expect that maybe in the next few days that the euro goes up while the US dollar also comes down in value. So I have made this speculation, right? And I want to buy. But how do I go about trading? That's when you come and you use a lot size. So first off, the lot is the size of your trade. So let's say I want to buy $10,000 worth of euros, right? That's my size. But instead of it being in terms of dollars, right? In this case, in the Forex market is in terms of lots. So we have something called the standard lot. That's like 100,000 units of the base currency, right? So it's 100. So if you are trying to buy the Euro USD, it will be 100,000 units of EUR. That is the euro, right? And you don't really need to know what the 100,000 units is, but the standard lot is what you have, right? And then from the standard, we have like different lots. So let's say someone says I'm trading 0.1 lots, then you know that he's trading 1/10 of the standard lot, and so on and so forth. So if I'm trading two lots, I'm trading 2 times the standard lot. So depending on how much you say is your lot size, right, that also depend on that also reflects how much you are risking. So someone who is in a trade on one lot is having more risk than someone who is in that same trade with 0.5 lots. And that same person with the one lot is having less risk or less risk or reward, right? To someone who has 100 lots on the line. So for any lot you want, you have to put up some money, right? And that is what is called your margin. So let's say I want one lot with a broker like Forex.com. Let's say you are trying to sell the USD CAD. That's the US dollar against the Canadian dollar, right? For one lot with Forex.com, as of now, it would cost you $2,000, right? So that's that. So and that $2,000 is your margin. It's how much you're putting up, and usually the margin is just a percentage of the overall thing. Because if you are actually trying to buy some euros, right? Maybe you are expecting a run for the euro, so you sell your dollars and get some euros, and you wait and you expect the value of the euro to go up, right? So that you can come and change it back for dollars, right? In actual sense, without Forex, which is like a very highly leveraged market, you can't really do that easily and expect as much profit quite smoothly. Anyways, so that segues into what is a leverage. And the leverage is the ratio of your how much you risk, right? Its actual value in the market and its actual value in reality. So let's say in reality you had 100,000 units of the euro, you had 100,000 units of the euro, right? It's not worth the same for someone who is in the forex market and has leveraged maybe 50 to 1, right? Because 50 to 1, the one is representing how much is actually worth, how much the 100,000 units is worth in reality, right? And then the 50 is how much it's worth in the market. Because in the market, since you have like this leverage, your broker is able to help you multiply how much you are risking and also at the same time multiply how much you're actually making. So if you are trading with 1:1, that leverage, it's smaller than a leverage of 500:1, 100:1, 50:1, and so on and so forth. This is interesting. So here we are on PIPS, and a PIP, you don't really need to go in depth into what a PIP is, because usually every trading platform helps you like easily calculate it. So you can use there are certain line tools depending on the platform you're using. If you're using MT4, you can just use that line tool and you'll be able to find how much a change in price is worth in pips. But anyway, for those who would be manually calculating it, a pip is just a unit of price change. And for most pairs, that unit of price change is calculated to the fourth decimal, okay? So let's say you are trading on the JBP, JPY, right? That pair doesn't give you 5 decimal places, so you can't go to the fourth decimal, right? Or it doesn't give you 4 decimal places so that you can go to the fourth decimal. It actually gives you 2 decimal places in terms of price. So let's say price would be at 126.02 for JBP, JPY. So for that one, in calculating the PIP is to 2 decimals, okay? And we have here on this example, let's say you are on Euro USD and the price is 1.00 1, 2, 3 at your start, right? And then your expected price, or maybe no. So in this case, it would rather be a sell. So let's say you are currently at 1.00134, right? And your target price is 1.00123, and you want to calculate the number of pips. Well, you subtract the current price and the start price, or your target price, whatever it is. Whichever way you do it, and you get a positive number, so you can use an absolute value, right? An absolute value between these differences, right? When you get that value, you divide by 0.001, right, to the 4th decimal place. So 0.0001, if I made a mistake. So for this example, it would have been 1.1 pips. And usually, depending on a pip is worth a certain amount. It also depends on your margin. So let's say your margin and your lot size. So let's say you are on the Euro USD and you put up one lot, right? You put up one lot, right? Right. So if price is to move a pip, that's worth $1. If I'm right. Yeah, it's worth $1, right? That could be your pip value. So one pip is one pip on how could I have made a mistake? One lot, the one pip would be $10 instead for Euro USD, right? So that's called the pip value, and it varies on pair. It varies between pairs. The APJPY could give you a different pip value for your current lot size, and so on and so forth. So how do brokers make their money? This is a very interesting question, and this question drives so many conspiracy theories. I don't even think most of them are conspiracy theories. I think like reality, to be honest. But from the outside looking in, this question drives so many conspiracy theories about like what brokers do and how they actually do make their money. You could think that a broker will make money when you lose money, which does make sense, because sometimes when you take a position, right? Because brokers know statistically that 99 points, I think that the stats is like 99.6% of traders will lose money, like over a year's period, right? If they are trading for a year, they'd lose money consistently, right? So for that 99.6%, that's like that 99.6% of people, if you are taking a buy, right, your broker would rather sell. And when you are taking a sell, your broker would rather buy. So he goes against you. Like he takes like a hedge position in the actual forex market that's against you. That's how some brokers work. So when you are losing money, they are actually making money. They are getting money from your misery. But the standard way that brokers do make their money is through spreads and through commissions. And commissions, depending on your account size, it's not everyone that is able to trade with commissions. So it's not every broker that offers commissions. So, but for commissions, it's just like a set amount that you pay upfront before your trade is executed. And the spread is a difference between your ask price and your bid price. So what is the ask price and what's the bid price? Well, the ask price is the price at which a retailer or a trader is willing to sell at, right? And the bid price is the price at which you are willing to buy at. So you can, when you are looking at the Forex charts, right? And if it's live and your broker allows it and he displays your bid and ask price, you can see that your bid price is always below your ask price, right? So if you were to decide to get into a sell, right? So you want the market to go down, right? instead of being executed at that point where you'd like immediately go down, your broker would rather execute you at the bid price, and vice versa. When you are also in the buy, he'd rather execute you at the ask price, which is not necessarily where exactly you wanted to get into the trade. So that difference is called the spread, and that's how they make money. So they just execute your order, or they place your order at a point that's a bit far away from your the price you actually wanted. So you can see that for every trade, you start with a bit of drawdowns. Some brokers have very tight spreads. Some have like very big spreads, and usually to the spreads depends on the pair you are trading. Because if you are trading a pair that's like a minor pair that like very few people do trade it, you have like wider spreads. But when you are trading a pair with like so much liquidity, like Euro USD, USD CAD, and stuff like that, for those ones you have like tighter spreads because like there's more liquidity, and your broker expects to make money with a tighter spread in that case. So lastly, we'll be talking about like the two types of analysis for people in general, like not just restricted to the Forex market, but like people in futures use these analysis methods, and people who trade indices, people who are into stocks and stuff. So these two analysis methods, the first of which I use and most traders actually use when they're talking about the 99 points, whatever people, most of the traders actually use technical analysis. Okay, so that's where you rely on chart patterns. So you look on your chart and see, maybe you saw a pattern of a dog. I don't see how someone would actually see that on a price chart, right? But let's say you saw a pattern of a dog, right? Price gets and it contracts and it looks like a dog to you, right? And at that point, over the past, you had seen the dogs multiple times, and with that pattern, you saw that price usually did something, right? So you expect that at this point, price will also do something, that same thing. So you take a trade in that direction. So let's say when you always see two tops, right? Or in the past, you saw two market tops, and you also have a trading strategy where there's a third touch of that top, and price usually breaks that and goes up, right? So if you are relying on that old pattern, you'd say when price gives that third touch, you are buying, and you are relying on chart patterns. Some chart patterns are more profitable than others, because some chart patterns or some chart patterns usually have one result. I don't think, or I don't know of any chart pattern that's 100% reliable, that if you see this, that 100% something else will happen, or something specific will happen. Usually don't have that. But anyone who does have that, I think that person has the holy grail of trading, and I'd like to know the person's strategy. So for technical analysis, you rely on market structure, price action. You can also rely on indicators. Maybe you are looking at the bottom of your screen for the crossover of an RSI or whatever. With whatever you are doing, indicators. A different topic for a different day. And the second type of analysis is fundamental analysis. This one relies on news, income statements, and like information in general. So let's say you want to buy Tesla, right? But instead of just looking at the chart, you want to check, hey, how has Tesla been performing? How much income do they have? How much have they retained? There's a lot of like micro and macroeconomics surrounding fundamental analysis. And if you do your research and you feel that Tesla is worth what, $9,000, right? And right now Tesla is trading at $2,000, right? You can buy and hold. That's fundamental analysis. So it relies on stuff that's outside. You can also fundamental analysis to you mainly, for most people anyways, like mainly in the Forex markets, right? They are mainly looking at news. So what is Donald Trump tweeting? What's the Fed saying? What's the interest rate going to be? Blah, 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 right? Usually when there's news, the market like violently reacts in a short space of time. So let's say Donald Trump tweets that I mean, he tweets crazy stuff, but let's say he tweets something that's like very negative for the US economy, right? Instantly, people decide to sell the US dollar, right? And people are just selling and selling and selling. So in that phase, in 30 minutes, you can see like major moves up to like maybe 100 pips. I mean, like so many pips, and the market moves very quickly, and it moves quickly with news. And that's how many people do trade the Forex market if they are using fundamental analysis, but there are other ways of doing it. So I hope you got to the end of the video. I hope everyone got to the end of the video, but obviously, no. But if you did, thank you very much. Very grateful that you were able to sit through my rambling and frankly, sometimes just incoherent speech. Thank you for watching. Please like and subscribe if you haven't already. I'm very grateful that you viewed my content so far, and I hope to see you on the next video. So until next time, keep hustling for that Forex money.